Welcome to This Explainer. Today we're putting on our cautious financial advisor hats and really decoding the 2026 crypto market. We're going to contrast two completely different worlds, the profound long-term macroeconomic theory of sound money against the chaotic, literally 24/7 reality of speculative day trading. We'll look at what's actually happening on the ground right now, and more importantly, how to navigate it safely.
So here's our roadmap. We'll kick things off with the crypto paradox, then step into the speculative casino. From there, we'll ground ourselves with the sound money theory, check out the 2026 regulatory reality, and finally wrap up with a cautious advisor's playbook.
All right, number one, the crypto paradox. Looking at this asset class today, it's impossible not to see a market that is fundamentally split. It's kind of like watching two completely conflicting realities playing out at the exact same time.
The paradox basically boils down to this. On one hand, you've got this hyper-volatile, speculative casino. Unchecked leverage, altcoin hype, just pure day trading chaos. But then, sitting right alongside that, you've got the sound money theory, a focus on long-term store of value, algorithmic scarcity, and hedging against centuries of inflation. To really get crypto in 2026, we have to grasp both sides of that coin.
Moving on to part two, the speculative casino. Let's zoom in on that micro-level reality first and see how the daily trading floor actually operates right now. What's totally wild here is the sheer scale of capital reacting to tiny, obscure indicators, like a sudden 15% jump in Bitcoin. And the trigger? Just a minor shift to cooperation on Delphi Digital's game theory dashboard, which tracks miner and institutional coordination. Just one little data tweak and boom, billions of dollars move, literally overnight.
So the short-term risk here is just off the charts. Take May 2nd, 2026, for example. In a single trading day, you've got a token like NF Prompt rocketing up over 37%, while at the exact same time, ACA USDT collapses by more than 51%. For an advisor, that is not investing, right? That's a roulette wheel where momentum can flip your entire portfolio in hours.
And hey, if you think this only burns the small retail traders, think again. The massive institutional players get swept right up in it too. On-chain data caught one whale accumulating $130 million in Ethereum at an average of $3,100, only to immediately swallow an $8.3 million unrealized loss when the market dipped. Size definitely does not grant you immunity in this casino.
The sheer breadth of the chaos is staggering too. On that exact same day in May, even with broad economic fears and the fear and greed index sitting at a super cautious 40, the market was buzzing. 275 tokens went up, while 115 went down. It is just hyperactive, non-stop trading spread across hundreds of different assets.
Okay, let's take a breath. Number three, the sound money theory. We're stepping away from the flashing casino lights now to look at the deep macroeconomic bedrock that birthed this whole asset class in the first place.
To really get our heads around this philosophy, we have to look at Saifedean Ammos's foundational book, The Bitcoin Standard. The core argument he makes is that decentralized digital assets, Bitcoin specifically, are basically our modern equivalent to the historical stability of gold. It's all about separating money from centralized political control.
When you map out the evolution of money, you see this massive trial-and-error timeline. We're talking 9,000 BC with primitive barter, moving to seashells and salt, all the way to the gold standard in the 1800s. Emmis argues that the switch to government fiat in 1971 was a massive deviation that sparked modern inflation. So in this view, the launch of decentralized digital assets in 2009 is actually a return to sound monetary principles.
Human rights advocate Alex Gladstein actually frames our current setup through this concept he calls financial privilege. He points out that only a tiny fraction of the world lives in a liberal democracy where the government can essentially just print paper money to go out and buy hard physical goods, like oil, from everyone else.
And that privilege leads us straight into the Cantillon effect. This is an economic concept where the guys closest to the money printer, the institutions creating the fiat money, get to spend it first before prices rise. By the time that new money trickles down to the rest of us, the inflation has already hit. It's a structural flaw that heavily drives wealth inequality.
That is exactly why sound money advocates see fixed digital scarcity as the ultimate defense. Think about Bitcoin's hard cap of 21 million. It offers a totally neutral, predictable escape hatch from unlimited fiat production and the Triffin dilemma. It's impartial, and it simply cannot be manipulated by a central bank. Moving to number 4, the 2026 regulatory reality. Because look,
Theory is fantastic, but we have to bring both that high-minded philosophy and the casino chaos back down to earth. Let's look at the hard facts of the regulatory landscape today.
The rules of the game are quite literally changing under our feet. The European Union's massive MiCA regulation hits its hard enforcement deadline on July 1, 2026. This is huge. It impacts over 3,000 firms. Unauthorized service providers will literally be forced to shut down. We are looking at hardened stablecoin reserve checks, strict anti-money laundering reporting, and traditional broker transparency norms becoming the absolute law of the land.
Meanwhile, over in the US, we're finally seeing clearer lines drawn between the SEC and the CFTC. By definitively classifying major assets as digital commodities, the litigation risk drops significantly. This makes it way more straightforward for institutional players to jump into spot exposures, as long as they have credible anti-fraud controls. Basically, the Wild West is getting fenced in.
Which brings us to number 5, a cautious advisor's playbook. So with the casino's risks exposed, the macroeconomic theory explained, and the new regulatory fences going up all around us, what's the bottom line? How do we actually play this safely?
Well, it requires a total mindset shift. We have to stop thinking like reactive speculators and start acting like structured, risk-aware participants. A speculator looks at a stablecoin delisting as this random, sudden shock, right? But a prudent advisor, they treat regulatory status as a highly calculable liquidity and settlement risk, and they proactively plan for it.
Your competitive edge really comes down to executing 3 core steps. Step 1, venue due diligence. You've got to prioritize authorized platforms that fully comply with MiCA. Step 2, stablecoin diversification. Do not depend on a single issuer because forced delistings are gonna happen. And step 3, document compliance. Keep immaculate audit records to safeguard your capital against any regulatory pushback.
I want to leave you with this final, provocative thought. As these strict new global regulations systematically dismantle the chaotic, speculative casino we've been watching, will the underlying theory of sound money finally be realized? Would actually stabilize the future of global finance, or will it just remain an incredibly fascinating theory? Thank you so much for joining me for this explainer. Keep learning, stay prudent, and I'll see you in the next one.